Cautious optimism that we've expressed in our last few monthly updates has spread more widely through the markets and to forecasts for next year. An explanation of this improvement in sentiment in our last update for 2020. The economic data for Australia has been one-way traffic over the last month, beating forecasts for GDP growth in the third quarter, business and consumer confidence now up to multi-year highs, and for the housing market, increases in dwelling values for all capital cities and for regional property in each state and territory. The Q3 growth rate of 3.33% was well ahead of consensus, and that was prior to the tax cuts and the range of budget spending initiatives and the recent positive news on a vaccine. As we've mentioned throughout this year, the timing and efficacy of the vaccine has been one of the key unknown variables that would drive confidence and the markets through the pandemic. And, as the chart shows, while the low ebb for sentiment was back in May before a mid-year pause, the vaccine news has now provided the fillip for the next leg higher. Of course, we need borders to remain open and the economic news to keep improving to sustain this trend. But stock markets are factoring in a broad-based recovery next year. And as of today, our ASX 200 is slightly higher than the start of the year, a remarkable outcome given the depth of the recession. The employment data out next week will be crucial to show that the jobs recovery is continuing, even as support from JobKeeper and JobSeeker tapers off. But for now, it still appears to be a V-shape, similar to stocks, sentiment and GDP growth. And it's worth keeping in mind that the number of workers supported by JobKeeper has fallen from 3.6 million to under 1.5 million since September. Assuming this trend continues, 2021 can be a year where JobMaker takes the reins from other support measures, and when the unemployment rate, having peaked at 7.5% in July, can continue to slowly improve. It's not all good news for our economy, with the escalation of trade tensions with China, which is showing no signs of improving, but at least the iron ore price is up at a 7-year high to offset some of the impact from other export markets, which need diversification if demand from China is to fall more permanently. And lastly, the resilient housing market continues to recover from the COVID-19 shock at the start of the year, with volumes for owner-occupier loans now at record highs. Given the RBA has signalled no increases in interest rates for 3 years, this market looks set to power ahead, especially in a post-pandemic economy. So, while investor activity has been more subdued, given the uncertainty ahead, a sustainable recovery from the recession may well be helped by rising asset values, as long as they don't rise too quickly. 2020 has been the most challenging of years, so this more plausible path to a sustainable recovery is a great relief. Wishing you all a safe and restful holiday season. That's the market update from Bendigo Bank.